Good afternoon or good morning, depending on where you're joining us from, and welcome to our final closing session for the Investable Showcase Virtual 2020. Thank you all for joining us, and we have a fantastic panel ahead of US investors joining us both from the East Coast and indeed Caroline from the West Coast, getting up nice and early to come and share her thoughts and insights with you all. I'll shortly be handing over to Bill from Mintz, who is going to be our moderator for this session. Just a quick reminder of the networking drinks reception and speed networking session taking place shortly after the panel, which I hope you'll all be able to join. And indeed, hope you're all looking forward to those who are attending the Jefferies Healthcare Conference, which is proceeding over the next few days. Today's panel is focusing on the US capital markets in a nice synergy from our keynote session from George at McKinsey earlier. I guess now hearing from the horse's mouth of, as it were, as to the current US capital markets environment and what leading investors in the space see as the future. So without further ado, I'll hand you over to Bill. The stage is yours.
Hi, I'm Bill Hicks. I'm a partner at Mintz in Boston. I work with public biotech companies as well as underwriters and hedge funds, and particularly trying to take companies that are private public in the US. Caroline, do you want to introduce yourself?
Sure. Good morning, everyone. My name is Caroline Stout, and I'm a principal at Equar One Capital. We're a biotech therapeutics investment firm based in San Francisco. I've led a number of Equar One's investments with a particular focus in the cell and gene therapy space. I joined the firm 7 years ago, and I was formerly a healthcare investment banker at Credit Suisse.
Jeff?
Yep. Good morning, good afternoon. Jeff Schwartz. I'm a managing director at Bain Capital Life Sciences. We're a fund based out of Boston, focused on therapeutics, devices, tools, and diagnostics, and funding companies in clinical development and early commercialization across that spectrum. We're investing out of a $1.1 billion fund, and great to be on the panel this morning.
Rachel?
Hi, everyone. My name is Rachel Mears, and I'm a partner with Q2 Capital. Q2's based out of Paris, France, but I'm the New York partner, so it's nice to be here. Our fund is focused on biotherapeutics, anywhere from post-technical proof of concept all the way through clinical stage. It's nice to meet you.
And Naveen?
Hello, everyone. I'm Naveen. I'm a partner and portfolio manager at RTW Investments, roughly $4 billion dedicated healthcare fund based in New York, focused mainly on biotech and therapeutics, although we have a healthy exposure and efforts in medtech and diagnostics and services. And that's the area that I focus on mainly.
Okay. So we have had a incredibly busy 2020. It seemed like when COVID hit that we had a couple weeks where things were kind of sputtering, and then it just took off. Everything, tons of IPOs, huge crossover rounds, companies that were hot, raising tons of money, public companies that, weren't necessarily particularly hot, raising tons of money. I'd say it only seems like only the companies that were private that weren't hot that were they're struggling raising money. How do each of you see this playing out in the next year, post-election, whatever phase we are in COVID? How do you see the next 12 months playing out? Caroline, I'll start with you.
Yeah, it's interesting. I think biotech has had kind of a chance to redeem itself.
Caroline, how do you see next year playing out? Oh, sorry.
Can you hear me now?
Yes.
Perfect. Okay. Yeah, I was going to say, I think biotech has had a chance to redeem itself after the drug pricing rhetoric of 2015 and 2016. COVID has really given biotech companies an opportunity to share their value with the world. And I think we're kind of only seeing the beginning of that value creation. Obviously, there have been a ton of opportunities to finance And I think that that will continue through 2021 with different vehicles, different modalities. And I think it's great to see so many biotech companies actually have the chance to capitalize themselves properly, because if we do have some kind of a pullback or cyclical kind of shift in 2021, there will be a lot of companies with strong cash balances to continue to operate and progress their science.
Jeff, what are you seeing this year? Do you see it slowing down, or do you think that's going to continue? And are there any particular industries you see, any sub-industries taking off?
Yeah, well, I'm glad I'm not day-to-day public market in what we do, and therefore have to be accurate in that prognostication. But I think what's behind all of this is what's been a multi-year and will likely be a multi-decade secular trend going on, right, in the form of innovation and the way that innovation is taking place, both on a fundamental scientific basis, but also just the way companies operate. And so there's just been an increased pace of that with a higher degree of, what I call fragmentation in the market, right? It's not just the landscape of brute force out of big pharma. There's real, by design, intelligent design, innovation taking place. And you're seeing that not only across biotech, but you're seeing that in med tech and diagnostics, which for a while had not been the case. So I think that's driving the growth of and maturation of the industry, the maturation of the capital being provided to it. And so I expect that to go forward. I expect there to be cycles. I've thought that for a while. I've yet to see one that's lasted more than 6 months in the last, half decade or more. So we'll see what comes in 21. But I agree with Caroline that many companies that have advanced have been taking advantage of the times and raising appropriate capital and really funding balance sheets in the appropriate way, which is what we really look to. So people should be able to weather the storm. But I don't see anything imminently on the horizon, given the politics in the U.S. or otherwise that's going to disturb this. But normally it's some endogenous sort of like something just quirky always happens at some point, and the question will be not if it will happen. Is it a pause for 3 months, or as COVID came along, it was a pause for like seemingly a month, which is pretty remarkable in and of itself, or is it something longer? So I think companies need to, continue to think full and long around their profile and what they're trying to achieve, and recognize that there will be times when it's not opportune. But I think long term, there's a lot of capital and a lot of great innovation, and that partnership goes together.
Naveen, how do you see this year playing out?
Sorry, I was on mute. I think we're going this year, and then obviously, into the stub this year and into next year. I think we're going to see more of the same. I agree with what the other panelists said. I think the innovation that we're seeing, it continues to accelerate, and that is the engine that drives pretty much everything that we do in our seats, public and private. There are different subsectors of healthcare are sort of in different places or spots on their innovation growth, on the innovation curve. Biotech is clearly in its very strong innovation cycle, and medtech is getting there, and certain pockets of medtech we're seeing more innovation now than they've ever seen before. So I'm pretty excited. I think we're going to see more of the same, if not better, from the innovation standpoint, which will translate to strong IPO market.
Do you think any of the external factors, whether it's the COVID or the lockdown, that are hurting industries are actually helping biotech in the sense of interest from investors generally, or do you think this is just an innovation cycle?
I'll weigh in on that one maybe for a moment, Bill. I'm going to choose, option C, both. Always the one, always the one to make the own option there as the venture focused person, I suppose. For two reasons. I think, look, COVID's been a rapid accelerator in a certain way for the path to market for a lot of therapies that quite frankly weren't getting a lot of attention. If you went to infectious disease and vaccine pre-COVID, it was hard to get attention, certainly in private fundraising. So the pipeline was tough, and companies that went public sometimes had a tough go. of holding and sustaining their value. I think those times are gone a little bit. And so there's a more fundamental accelerator, I think, but it's too early to say how that will really fuel the demand, which I think is massive global-wide cooperation at all stages of innovation around the COVID crisis. And there could be some enduring changes in the infrastructure of healthcare, including regulatory pathways, setting up CMC, shortening timelines to market that could eventually help not just sustain the innovation, but the value build to path to market. So to be honest, I won't say it's a net positive, because I know we all wish we didn't have the crisis, but between the attention on the space, quite frankly, and the fact that they've taken innovation and development cycles and more than halved them. I mean, something that used to take a decade is taking 2 years, will have, I think, enduring impacts and could in part be driving some of the demand in markets that know quite fundamentally healthcare is an enduring need and requires innovation, but also investment and produces good value.
What about, one thing that everyone who's on this panel is interested in is European, great European innovation and European companies, I think, generally are trying to get access to the U.S. capital markets just because the European capital markets aren't yielding very good liquidity and access to capital. Are you seeing, is COVID, in terms of finding, for you guys looking for good European technology to invest in, are you seeing, is COVID getting in the way of that, the inability to travel? Is it interfering with your ability to source good companies, or is that happening at the same rate? And are there any lessons in this environment?
I would just offer, JTO's based in Paris. We're going to have, we're a relatively new fund, just closed at the end of December on our first fund. Deal flow out of Europe has been robust. With excellent science and excellent opportunities, I would say. So I don't actually see that cycle from an innovation standpoint slowing down at all in the next year. I do think that Caroline brought up a fundamental point that's quite important, regardless of continent, but very important in Europe if your path is to a public market in the US, and that is continuity of capital and thinking about that from the beginning, because you want that to be an optimal choice at the right time, and you're going to hit bumps. And so I think one thing that we think about when hunting for those really quality companies, entrepreneurs, investments, is how to bring that capital to bear with the right way, with continuity, so that it isn't disjointed. Development, because of COVID, but many other things, but COVID's a great example, can really be disrupted in the early days. And so how you raise capital and how you syndicate, if that's also an option, is something I think entrepreneurs and their early investors should talk closely about.
And by continuity, do you partly mean don't just fund station to station, but actually fund sufficiently up front that you can go through a few bumps? Is that part of what?
I mean, two things. First, exactly what you just said. And second, I think, choice of investor. I'm not saying that a company necessarily has the wealth of choice at every stage of its development, but I do think that there is a lot of capital out there, and the match between what a company is going to have to do and its investor pool needs to be a good one. And so I do think the ability to have follow-on investment from your investors and the ability to syndicate a network is quite important, and that's a component of continuity, certainly.
Great.
I would say in some ways, actually, COVID has made our interactions with European biotech companies more frequent. It's just so much easier to have these Zoom calls and meet with people face to face rather than waiting for them to make their one annual trip to the US. So while we might be getting our ideas and sourcing from slightly different places, Igor One gets a lot of ideas from traveling to medical meetings and seeing what's hot off the presses. But I would say in terms of building relationships with European companies in particular, being in San Francisco, actually COVID's been quite conducive to that.
And Jeff, are you actively seeking companies in Europe, and have you found that changes or?
Yeah, we've invested in several companies in Europe, in their private stages, and I agree with what Caroline just said, which is in some ways COVID's an equalizer. We don't meet many management teams, and actually I've not met management team in person since February, as crazy as that may sound. But that just makes it all the easier. So there's an equalization here, and the reduction in travel, and opening up opportunities. So we're active in there. I'd say obviously the networks are slightly different, and so the conversations, you still got to work to create that, but the ease of getting on a call and finding time with teams is quite simple. And we've got several of those going on right now. In some ways, it's easier than ever.
For European companies that are looking to meet people like you guys, are there any things you are seeing? European practices? I know station-to-station funding is one of them. Are you seeing any practices that aren't as attractive to a U.S. company? In others, do you have any sort of pro tips if you're looking to get access to U.S. investors like you guys and get onto the U.S. capital markets? Is there any way that you're seeing British and European companies acting that they ought to think in a different way about?
Maybe I'll offer some thoughts. Yeah, sorry. I think it all starts with innovation, and I'll echo what I mentioned earlier. I think the innovation, not just in the U.S. but in Europe, is booming, and we are doing our best to form relationships in Europe. We just launched a UK-based venture fund and starting an office in London, but that's not enough. That's that's sort of like setting up an office in San Francisco and not really being able to do anything in Boston. It's, there is the unfortunate reality that a lot of the, European companies do have to set up those relationships with U.S. partners as well. So we're trying, very hard to reach across the pond, and because there's just some incredible innovation all over Europe, UK obviously, and then mainland. As far as tips go, I think is just continue to develop a relationship with U.S. partners. Either that would be with either forming a relationship through banks or working, just seeding the ground and taking the time to develop those relationships. It's I don't think there's any necessarily secret sauce.
I would actually just add that one of the things that I think is important, specifically, Bill, on the second part of your question, which is how do you think about accessing investors, particularly as you get closer to perhaps a public exit or more maturity as a company based in Europe. And I think one of the things there is to be extremely thoughtful about how you build out your executive team. I mean, I'd love for it to be all about how you network with us, because that's really important in sourcing and syndication and getting the continuity and support. But I think it's also about being very thoughtful about the signals that you're sending as you mature as a company in terms of what your ambitions are for the company to drive value going forward and ultimately benefit to the patient. And I think a lot of that ends up being, how are you thinking about forming the leaders in your team? Who's your choice of CFO? How do you get validation with attracting the best talent? Because simply that's going to construct a value return that goes beyond your innovation. And I think that's part of what the story has to be about. And quite frankly, the fundamentals have to be about as you get ready for whatever ultimately you're going to do in a US market through whatever route or vehicle there has to be. So, I know one of the things that we do even from the beginning when we're networking meeting is we ask very thoughtfully about the existing team, but also as you mature, who are the major talents that you'd want to bring in? How do you think about building out that part of your company? Because we think those are going to be hallmarks of value if you're going to IPO or however you're going to access the public markets in the US.
I think the only other piece that I would add to that is that a lot of times we see European companies have very different incentive structures or less incentives for management teams than US-based companies. And so in order to get everybody on the same page, we actually like to see CEOs have more skin in the game, especially in the long term, to just be more aligned with investors. And that's one challenge we've had historically with European biotechs. So that's one kind of concrete piece of advice I would give is make sure you're aligned with your investors more than just strategically.
You mean skin in the game? Are you talking about equity compensation, essentially making sure that they have a U.S. style equity? Okay.
Exactly.
I completely agree with that.
Okay, terrific. In terms of so for companies in Europe looking to go to the U.S., one of the features of the last several years, at least, of biotech IPOs is that you almost always want to have a so-called crossover investment first, which I would characterize as, you know, a combination of VCs, but also more traditional public investors combining to do what looks like a VC round. But what's important about it is it's got public investors coming in, which which tells the markets public investors like this company. And then when you go to the IPO, you've already got some public investors that are already interested, and that makes it easier to sell the deal to the rest. So are you guys, if I'm a European company thinking, how do I get one of these crossover rounds? Are you guys still seeing that as an important predicate to doing a successful IPO? Is any tips to European companies looking to get in on this? How do they get their crossover round?
Maybe I'll offer. RTW is officially, we officially call ourselves a crossover fund because we do mainly public, but a healthy amount of private. I think the crossover sort of phenomenon, which started maybe a few years ago, will continue. I think it's even more important now than it used to be, simply because there is so much innovation, and it's just not realistic to expect pure play public funds to be able to do diligence on 6 exceptional IPOs every month or every quarter, what we're sometimes what we're seeing. So there is a validation from having a crossover fund. You can't rely on the bankers to do that diligence, maybe which you could do 10, 15 years ago if you're not a biotech specialist or a healthcare specialist. So I think I do believe the importance of crossover funds will continue, simply because innovation will continue. Now, the second part of your question was, how do you get in front of crossover funds? I think it's pretty similar to what Rachel and Caroline and folks have said. It's having the right story, the right networking, the right management team, showing your public ready.
And it's getting one anchor key, is finding one believer to start the ball rolling.
I think every situation is a little bespoke. I mean, it sounds intuitive, probably. It makes sense. But yeah, I think there's a lot of variability.
Okay, great.
Look, I think it's important to have your existing investor pool aligned with you on how you're going to go into the US market. And I think, you can't underestimate the crossover as part of that conversation as well. And so, I hate to put it squarely on the shoulders of a CEO, because it's not, it's also the board. But, if you're planning for a crossover or any sort of exit into a public market into the United States, I think there's all the hallmarks of what you have to do with your story, but there's also a lot of alignment that needs to happen, because the crossover, as the first step of an IPO, if the 2-step is what you're going to do, it's all about existing investor alignment. And I think that goes all the way back to what Caroline said. So there is a bit of a heavy lift in thinking, I think, with the CEO as the center of a lot of that, and having good board alignment through the earlier rounds, with strong conversation about exit paths, and some transparency and engagement there, I think goes a very, very long way.
Okay, great. What about, one of the things that's been interesting about the U.S. capital markets is there are different ways to get there. One is crossover IPO. That's certainly the simplest way to get there. And if you have all guns blaring, I would usually say that's the best way to get there. One thing we're seeing a lot of right now as an alternative, however, is SPACs, which are, basically a sponsor like any of you, pools together a bunch of money. It might be $100 million. You get it listed on an exchange, and then you go try to find a private company to merge with. And then the key is to try to get the 100 million to stay when you pick a partner. What are you guys seeing in SPACs? Do you think they're an important vehicle I'll start with you, Naveen. What are your thoughts on SPACs right now?
Yeah, we're RTW. We're pretty active in the SPAC space as a serial sponsor. We're on our second SPAC at the moment. I think for a healthy percentage of the companies, it is potentially a very attractive route. It combines the goal is to combine the crossover and the IPO round into one, so potentially a single round of dilution rather than two, and have a built-in institutional syndicate, specialist investors that you would want anyways. And then there is the ability to do some sort of occasionally innovative structures and alignment of structures. So yeah, it remains to be seen how biotech and medtech will, what percentage of the IPO market will be, sort of penetrated by the SPAC vehicle. But yeah, I'm excited about the SPAC route.
Are there any kind of companies that you view at, you're looking at a company you think is exciting? Are there any characteristics where you'd say, I'd want to do a crossover investment in this one, but I'd like to actually deploy my SPAC on this one? Are there any, is it all the same, or is it further along? Or are there any things that make a company a better fit for a SPAC?
I think great innovation is great innovation. So that's probably, priority or, check the box number one. But outside of that, it's hard to kind of paint broad strokes. Every company has their own idiosyncratic needs. They have their own investor base with, different parameters and incentives. But I do believe every company should at least have a SPAC as part of the conversation as far as their capital needs.
Also a great way for a company to get a crossover and an IPO done all at once. So if you're a company that could benefit from a larger slug of capital than what a crossover might offer, for example, there are no inflection points after your typical crossover, a SPAC might be a great vehicle to think about, because it actually bridges investors and you to that critical piece of information or data that you need to have play out. I think it also makes a lot of sense for European companies, because you get access to a ton of these great investors that are US based in your crossover, and then you also have them as IPO investors, assuming they all stick with the SPAC in the end. So I agree with Naveen. It's a great vehicle, and I think it's here to stay.
I would only. Oh, go ahead.
Sorry, Rachel. I would just add that within that, in terms of the qualifications, you need to raise a certain amount of capital. So these things and these SPACs make the most sense when it's not just the amount of capital in the SPAC, but there's substantial and meaningful concurrent pipes. And that drives the connectivity to a broader shareholder base. And so you have to have an appropriate and a reasonable need for enough capital to be in a position. Normally, if you're going to do a crossover and an IPO, you're in that camp anyway. You probably, as Caroline said, it fits the capital structure for what the company's actually doing. But I think the big advantage and a big opportunity for companies that have either more complicated stories, if you will, higher number of assets, or just less well known for whatever reason, and that may apply to some companies in Europe. The ability to find a good sponsor who says, "Yep, this is interesting," that brings a lot of attention that might otherwise take a lot longer to pull together, and that can be pretty beneficial through the system.
I would 100% agree with that. As somebody who, we don't have a SPAC. We partner, over 2/3 of our portfolio are actually going to be sourced from Europe. And so when we think about how the US markets might be an opportunity for a European company that would be in our portfolio, we want to be thoughtful about how the sponsor investor is going to be engaged. And I think that could be one of the big, set aside all the technicalities, that could be one of the really big advantages, that if you're in the crossover and then the IPO and you're in the middle of execution rather than inflection, as Carolyn pointed out, having a sponsor, and then without having to do the giant roadshow and having the direct engagement with somebody who's very well qualified in the space and interested, can really be a very positive for a company that should be working on its execution to make sure it's hitting the subsequent public value targets.
I would add one other thing, just especially for European companies thinking about this. You don't have to have all your books ready to go public, but you can't be like 9 months away from having your books either. And so the SPAC facilitates that, but there's still a readiness from a financial systems and component. So it can ease some of that through, but you do have to do some of your own homework around the viability of your own organization and capability to be able to get there.
I liked your original point, because I think with SPACs and also reverse mergers, which we'll get into, you're essentially going public in connection with a private marketing process. Like when you're a SPAC, you're really doing a private marketing process. And so for a company that's complicated, that's not obviously and simply appealing, the private marketing process gives you an ability to find a sponsor that a public offering process just doesn't. Which I think that's an interesting question, because a lot of times we get bored saying, "Hey, I was talking to so and so about a crossover, and they're pushing their SPAC. Should I do it?" And it's always hard to answer that question, why they should or they shouldn't. But that's an interesting point. Caroline, looked like you had something. Was there something you wanted to say? Oh, sorry, Connor.
No, I think. No, I think it's a good question of whether you should or shouldn't. I mean, I'll add, I don't think it's always necessarily that a company needs to have more complexity. It could be also that a CEO just would rather spend his time focusing on or her times on running the company, and the SPAC offers a very accelerated path to crossover and IPO. I mean, you can get it done in a matter of a handful of weeks rather than two long dragged out processes. So, I would say we're trying not to necessarily just focus on companies that may have this complex structure. We're being pretty agnostic to potential targets. But of course, Jeff is right that a lot of companies with slightly more complicated stories may find this SPAC particularly attractive.
And what about one of the things with SPACs is they look more complicated on their face. In other words, you're not just looking at valuation, you're looking at the promote, you're looking at the warrant coverage. If the SPAC has warrants. I think I've heard some SPACs say, "Hey, you're actually going to get a better valuation." I'll start with you, Naveen. How would you, to a board that's saying, I don't am I getting tricked? I don't know. And there's a lot of variables. The SPAC may have $100 million in SPAC investors, but only 25 million may stay at the closing. So you really need to go out and market a pipe. How do you articulate to an issuer, just from a numbers perspective, whether it's a good deal or if it's going to be more diluted to do a SPAC than a normal crossover deal?
Right. Well, there's certainly a significant amount of education. SPACs are still not in the typical parlance yet, although it is much easier conversations than it was, say, a year and a half ago. I remember with our first SPAC, 80% of every meeting was explaining what's a SPAC. Now that's both with investors and
right.
with the private companies. Now it is night and day. I rarely come across management teams that are sort of further along their fundraising cycle who are now at the point of considering a crossover, which would be the appropriate time to think about a SPAC. I think everyone has a pretty decent sense of what a SPAC is. Now, obviously, the devil's in the details. Every SPAC is different. The structure of the public and private warrants, if there are public warrants, as you mentioned, how the working capital is set up, and those are every SPAC's going to have their own sort of nuances, and that just needs to be explained to the boards and into management team, and what's in it for them, and what does NewCo look like versus the various routes. And then one thing that also can't be underestimated is the time to going public. These are all cash burning companies, so to the extent that you can accelerate your time to your process to the public markets, at which point you have now you're going to do secondary after secondary, but presumably at a higher valuation. if you get a SPAC done in 5-6 months versus a 12 to 18-month IPO process, I mean that's a very big deal. On top of all the vendor fees that you're 2 rounds of banker fees, 2 rounds of lawyer fees, and so forth. I'm not sure if I answer your question, but those are probably some early thoughts.
Probably never been a
No, that's
better
great.
time to be a potential target acquisition company, because there are so many SPACs out there now that everybody's competing with each other, frankly, to get some of these great companies. And so I personally don't think that we'll see the same velocity of SPACs that we've seen in 2020. But I think there will be a world of great funds that have had phenomenal success with their SPACs, like RTW has, and those will be around for companies as options going forward. But right now, the plethora of SPACs out there is actually, I think, made it pretty favorable for target companies looking for attractive terms to go public with.
The other thing that seems to be interesting is the healthcare SPACs seem to be evolving into a particularly healthy instrument. The knock on old SPACs was they just have these SPAC investors were people that weren't going to be interested in whatever business was acquired. They just wanted to take their 2% interest in their warrants. Whereas it seems like a lot of these new healthcare funds are actually loading up with healthcare investors, so they're more likely to stick around. And it seems like some of the more recent SPACs have also done things like playing with things that used to be, fixtures, like maybe not having warrants to make them more attractive. Are you guys seeing that as well? So they're actually starting to look kind of like a SPAC is, you've already, it's like a crossover going public and you've already got your anchor investor, it's starting to look more benevolent. I mean, are you guys seeing that kind of an evolution as well to make them more standard looking to the companies?
Yeah, I think maybe 3 of us here have SPACs. I think I'm the most recent one who was raised, so I'll be the most recent in the comment, which is I wouldn't say I'd say everything you just said, but yes, it's done. Like fundamentally, the way that the life science SPACs have evolved quite rapidly is markedly different than the rest of the SPAC market, and the function's very different. And I think that's a really important part for people to understand, which is in our world, the predominant form is established investor who typically was involved in some form of private rounds and crossovers in the public, offering to consolidate the crossover round with the public round for all the reasons we just spoke about. And it's anchored by fundamental investors who typically invest in those crossover rounds and in those IPOs. And those become the dominant amount of capital in there. And most of them look to participate in commensurate pipes. And when you do that, you know that the capital in the SPAC itself is also going to show up. So I think, look, we got onto this because one of our portfolio companies, a company called Cerevel, chose to go public through this in a large transaction. And that SPAC, in a world where many broader market SPACs now are seeing a lot of redemptions as they get to the end, had effectively de minimis redemptions because of that. So I think everything you said is true, but it's more so than that. It's not that that's where it's evolving. That really is where it is already. And I think the folks that led a lot of this early on, and RTW is one of them, have created a real value creating opportunity in the industry versus just the other alternative that you had talked about. And I think it's rapidly become mature, but it will still mature going forward, and there'll be a range of different players out there. But it's a really good alternative to what exists out there.
Rachel, as a European, I was going to say one. So I guess one message would be to people in Europe who have heard of SPACs and heard they're very mercenary and they're, beware. The healthcare SPACs are actually a different animal, and if they're coming from promoters. Rachel, do you want to?
Yeah. I mean, look, I think when you're working with European-based companies and entrepreneurs and quite frankly, existing investor pools. I think one of the hallmarks that we've said from the beginning, and it's very simple with SPACs in this space, is the sponsor. I mean, you're attracting extremely high quality, very sophisticated anchor sponsors. And, you know, if that's not the case with the SPAC, that's probably the top of your list to look at it. And there aren't that many in this competitive space who don't have extremely high quality sponsors. So that would be, I mean, just to be very simple about it. But I do think it's worth it to step it back a little bit, because all of the folks we have on the call today or on the panel also have a lot of experience in all of the other alternatives, right? And one of the things that I think is important for European companies to think is that a SPAC is a now potential route, and it has advantages, but there are other routes too. And I think when I think about being an investor with a portfolio of companies, there's going to be choices each have to make that are right for them, you know, including the fact that what's on the other side of going public is a public amount of scrutiny on what you're doing. And one thing that we have seen in the US markets in the last 18 months to 24 months is the number of extremely early stage companies going public. And so I think one of the things that just has to be thought through is what route is right for you. You know, what route is going to be best for you. And this is one that is potentially revolutionary for certain companies in the next 2 years, but it's not the only option.
And in that spirit, you know, one other alternative that we haven't touched on is what I call a fallen angel reverse merger that we're seeing a lot of, which is you have plenty of U.S. public companies. They have $70 million in cash. Their phase 2 drug study crashed and burned, and now they have cash. What do I do with it? And they basically become a VC, and they go out and find private companies to merge with them. And the private companies basically compete for their cash and their listing. And that's a way to get public. How do you guys, you know, those have always, I'd say those they've always been out there. There've been a ton of them lately, but partly because we're seeing a lot of companies go public early. And when you have a lot of companies go public early, you have a lot succeed, and you have a lot of them go bust with a lot of cash left over. Do you see those continuing at pace? And as an investor looking at those companies, how do you view those? You know, once a company's public by that means, are you just as happy as if they went public by SPAC or IPO, or do you look at them differently?
I would say similar to the SPAC world, we're seeing a little bit of an evolution on the reverse merger. You know, you're right. It used to be sort of the dirty way to go public, similar with the SPAC, but I think that is changing because every company has their own needs. Just talk about one of our companies, Rocket Pharmaceuticals. You know, one of the very successful gene therapy company went public through a reverse merger as well. So we're not, you know, for our portfolio companies, private and our public, we're not afraid of the reverse merger. You know, the innovation is there. Getting into the public markets, you can take many different paths and there's many different vehicles. Now, I would say the reverse mergers now have to compete with the SPACs because there are, you know, plenty of reasons why one would want to go with the SPAC instead of a reverse merge shell, because, you know, you usually have a more intact balance sheet. It's a cleaner situation, maybe less legacy issues. So every situation will have its own idiosyncrasies, but no hard and fast rule against reverse mergers, in my view.
Caroline, your thoughts on those, the reverse merger deals?
Yeah, I agreed with Naveen. I mean, now a lot of these reverse mergers have to compete with SPACs. I think the thing to look out for whenever you're thinking about doing a reverse merger is what are the other liabilities that the company has to contend with. Sometimes the cash on the balance sheet isn't always readily available. So that's one of the analyses we do when we think about investing in some of these kind of cash shell companies. So that's one piece to think about, but I don't think they're gone. I mean, sometimes there are also, you know, kind of zombie assets at companies too that private companies can take advantage of when they reverse merge into this company. We just did this with Aduro Biotech. Chinook reverse merged into them, and they combined their Aduro was an oncology company with a kidney asset. that pipeline didn't totally make a lot of strategic sense for them as the combined company. Chinook is a kidney company, so they took the kidney asset and the rest of the cash and the public shell. So so sometimes it can make sense for other reasons too.
And that's a good example of how bespoke those deals can be, because that company did the reverse merger. It got the asset, it got the cash, it got the listing, but it also raised about 100 million while it was in the process of closing, which just goes to show how creative these things can be.
I think it gets to a very fundamental point, Bill, which is that for some investors, you know, if you're going to suggest to them, hey, I'm going to do a reverse merger, right? And you're in one of the later rounds and you say, I think my path is a reverse merger and I've got these options. You really need to be as detailed as Caroline about it, because it will start to scare off the rest of your money, because a lot of people will look at reverse mergers and go, an extra executive team potentially, synergy, but expense, you know, 2 footprints potentially. And so, you know, just a sense of it really could be a route for a lot of companies, but it really needs to be thought through as much with your current board, or if you're actually doing a later stage round and you think that's a route. You know, I think most investors look a little more deeply than, hey, I've got a quick path to market and it's reverse merger. I mean, it could be a turnoff.
I think one of the fundamental things that, and there are other kinds of reverse mergers called a Form 10 reverse merger. So there's all kinds of choices. I mean, I think bringing it back to your point, Rachel, what's important when you're approaching these things, it's really about getting the money, the structure, the money and the good investors. The structure, you know, the structure is only helpful if it gets you to the money and the investors. So boards shouldn't necessarily approach this as, I want to do an IPO or I want to do a reverse merger. They should think about, you know, which investor, you know, what will get, you know, keep an open mind on all these structures. And if one structure takes them down the promise road to the right investor syndicate, then that's right for them. But to be educated about the details and not just react to what you heard somewhere that, oh, SPACs are bad, or this is bad, or you have to do this. It's all about the details in your situation. We got one question from the audience, which is, given the election results, the U.S. election results, what do you guys think will be the impact on the life sciences industry? Anyone? Any thoughts? Positive, negative?
I'll offer some quick thoughts here. You know, we'll see what the final outcome is. Obviously, perhaps if there does end up being gridlock, that is, you know, potentially we won't see quite a lot of significant changes for healthcare. And then, you know, some of the proposals that we've seen from the various parties seem to be a little bit more down the middle versus some of the extremes that we may have seen from some other candidates on drug pricing, for example. But one thing is also interesting is that I think both parties have expressed strong interest in supporting life science innovation generally, either through NIH funding or other mechanisms. And so I think we'll either see just continued progress on innovation and without tremendous amount of disruption to the whole supply chain and ecosystem. So, you know, pretty encouraging.
Well, Josh, I think we're out of time. I'll kick it back to you.
Thanks so much, Bill. And thank you to all of our panel for joining us today. Some great insights and I guess a number of things that we've been discussing throughout the last 4 days, which sort of come around full circle. So yeah, huge thank you to all of our panelists and to Bill as our moderator for guiding us through our sort of final closing session for the Investable Showcase Virtual 2020. I know a number of you will also be joining the Jefferies Healthcare Conference, which precedes the event starting tomorrow, so please do enjoy that, and very much hope that when we next run the Investable Showcase, we'll be able to do so in person and welcome you all in London, which has been our home for the Investable Showcase over the last few years. But with that, I would invite you, if you are interested in meeting some new faces and connecting with people, there is a virtual speed networking session taking place in the main agenda, so please do join there if you'd like. Otherwise, thanks to Mintz and to all of our other partners for joining and supporting us this year at the Investable Showcase. Thank you to all of our speakers from across the event for sharing their expertise and insights with you all. And we hope to see you again very soon, ideally in person. But until then, thanks very much.